Our presentation today features one of our research analysts, David Alkali. Please note the information and opinions discussed do not constitute investment advice. Any securities mentioned are not necessarily held by Lazard Asset Management and should not be considered a recommendation or solicitation to buy or sell those securities. All opinions expressed are subject to change.
Hello. In today's Lazard Insights, I will discuss recent developments in the U.S. housing sector. One of the puzzles that emerged in 2018 was that, even as the overall economy grew well above trend and the unemployment rate touched lows last seen in 1969, most housing measures slowed and sentiment deteriorated. In fact, when fourth quarter GDP data is released on February 28th, we very likely will learn that real housing investment contracted in all 4 quarters in 2018 and in 8 of the last 11 quarters. This development has been made more surprising by how weak the recovery in the housing sector has been relative to the overall economy. As we can see in this chart, which is indexed to the fourth quarter of 2000, even setting aside the boom and bust of the 2000s, real private fixed residential investment has yet to return to the levels of the late 1990s despite an economy that is roughly 40% larger. Given overbuilding during the boom of the past cycle and the fact that the financial crisis originated in U.S. housing, it was to be expected that the housing recovery would be slow. But is it possible that it is over before it really got started? In the coming slides, I will discuss our views on U.S. housing. First, we believe the economic backdrop continues to be supportive for the sector. Second, supply appears to remain tight by historical standards, providing additional support for future activity and price increases. Third, a variety of factors have likely contributed to the recent slowdown and disappointing recovery, chief among them rising interest rates and longer-term affordability issues. Fourth, we believe that as financing costs stabilize, both activity and prices should increase, although with important differences between local markets driven by economic conditions. Moving to the economic backdrop, we think of household income, wealth, and confidence as the decisive factors behind underlying demand for housing, with prices, credit access, and credit costs additional and important considerations. All else equal, the decision to rent or buy a home should rest on whether one has enough income and savings to afford it, and relative optimism about one's future income and savings. Recent trends have been supportive of these decisions, both in aggregate and across the income and wealth spectrum. Nearly 80% of aggregate income comes from employment earnings, and employment trends have been very strong. The blue bars in this chart show the monthly change in non-farm payroll jobs, and the yellow line shows the 12-month moving average. Despite the unemployment rate touching a 49-year low in 2018, jobs growth has averaged 234,000 per month over the past 12 months, well above the roughly 90,000 jobs per month required to keep up with population growth. Furthermore, there are 7.3 million open jobs, suggesting that robust jobs growth can continue. In this chart, we can see how jobs growth has translated to household income growth. Focus on the dark blue line with the dashed history, which has been imputed to correct for a break in the data in 2013. After stagnating for almost a decade, real median household income fell sharply as a result of the financial crisis. It only began to recover in earnest around 2014. From 2014 to 2017, it grew at its fastest 3-year pace in the history of the data series. Furthermore, households further down the income spectrum saw similar gains, as jobs growth began to be more widely felt and wage growth accelerated for lower-paying jobs. While this data is published with a lag, we believe this trend continued in 2018, based on the basic ingredients of jobs per household, hours worked per job, and real wages earned per hour worked. So, to sum up, household income statements have progressively become more supportive of housing demand, but for many households, this trend only began a few years ago. Household wealth also has followed a similar pattern, suggesting that while the drivers of housing demand were weak in the early stages of the recovery, they have strengthened and broadened in the past few years. This improved outlook has begun to be reflected in housing decisions. This chart shows household formation, or the rate of growth for the total number of households, which is defined as the number of occupied housing units. While there are some discrepancies between different surveys of this number, we opt here to use the highest frequency data, which is roughly consistent with a pattern of an average of available series. The black line is the year-on-year change in the number of households. As we can see, while it is volatile, it has gradually risen from a low of just 100,000 more households over the year ending in December 2008 to over 1.5 million more over the year ended in September 2018. What's also notable is that virtually all of the gains from 2008 through mid-2016 were driven by the blue bars, which show the net change in renter-occupied housing. Since mid-2016, household formation has flowed into home ownership, suggesting that not only is the improvement in household finances leading to stronger demand for housing, but also that it is driving more demand for the larger commitment of buying a house. To add perspective, roughly 1.3 to 1.4 million new households per year are required to keep up with population growth after taking aging into account. While in line with recent rates of household formation, this number implies significant residual pent-up demand for housing from the earlier years of the recovery, potentially as many as 5.7 million households, although the actual number is likely lower due to other factors like changing social preferences. Taking a closer look at home ownership, this chart breaks down the change in the home ownership rate from 2005 through 2016 with the blue bars, and the change from 2016 through the third quarter of 2018 in the yellow bars, with each column representing a subset of households based on the age of the householder. As we can see at the far left, the overall home ownership rate first declined by nearly 6 percentage points and has since rebounded by nearly a percentage point. Moving across the age spectrum, we can see that younger adults, particularly those in their 30s, experienced the steepest decline in home ownership rates following the crisis, but have since seen the biggest rebound. This is again encouraging evidence that some of the damage done by the crisis has only begun to reverse more recently in an environment of broader income and wealth growth. A final potential tailwind for the housing sector in the years ahead is the aging of the U.S. population. In particular, the relatively large millennial generation born in the 1980s and 1990s will begin to reach ages at which household formation and home ownership become more likely. Our analysis implies demand for roughly 1.3 million more households per year, with 1 million of those being owner-occupied, independent of any additional pent-up demand. In sum, population dynamics and delayed consumption suggest that potential demand for housing is relatively high, particularly among younger households, and could support the housing sector in the context of improving household finances. Moving to housing supply, most estimates are that it remains tight by recent standards, although some measures of inventories have risen in recent months. As we can see in these charts, the homeowner vacancy rate on the left and especially the rental vacancy rate on the right rose significantly during the housing boom. In recent years, they have fallen back to levels that prevailed in the early 1990s, suggesting little excess capacity to meet new demand without new construction. This observation is consistent with construction activity since the crisis. While there clearly was excess supply following the housing boom, fewer housing units have been built over the past 10 years than at any other point in the past 40 years by a wide margin, nearly 4.5 million units, without adjusting for the fact that the current population is much larger than in the past. Despite these dynamics, a number of measures of housing activity slowed in 2018. In the chart on the left of this slide, the blue line is total housing starts, which hit a cycle high in January 2018 that was still roughly 40% below their pre-crisis high, and which have since declined by about 6%. The yellow line is total housing permits, which tell a similar story on a forward-looking basis. In the chart on the right of the slide, we can see that home sales have declined more steeply. The blue line is for sales of new single-family homes, and the yellow line is for sales of all existing homes, both of which peaked in November 2017 before declining by 8% and 12% respectively. However, these headline statistics do not tell the whole story. On this slide, we can see the composition of housing starts. The yellow line, on the right axis, is for multi-unit buildings, while the blue line, on the left axis, is for single-family homes. Construction of single-family units, which accounted for roughly 80% of total starts before the crisis, clearly has been much slower to recover, reflecting the fact that weak demand earlier in the recovery was primarily oriented to housing more appropriate for rentals. This has slowly shifted in recent years. Nonetheless, single-family construction slowed in 2018, and, reflecting slowing activity, the pace of home price increases also weakened at a national level. As we can see in this chart, home price growth peaked in the spring and has since declined by roughly 1.5 to 2 percentage points, depending on the measure. However, when we examine the details of the Case-Shiller Home Price Index, the yellow line on this chart, they show that price increases have not slowed uniformly. 8 of the 20 metro-level indices are still experiencing home price growth more rapid than in 2017. 5 of these metro areas have yet to see home prices recover to their pre-crisis peaks, and the fastest home price growth in the past year has been in Las Vegas and Phoenix, metro areas where home prices remain more than 30% below their pre-crisis peak. Conversely, the biggest deceleration has largely been in metro areas that have experienced far more rapid recoveries from the crisis. Furthermore, national home price data from Zillow reveals another important dynamic. Homes with prices in the bottom third by value have experienced much more rapid price growth than those in the top third since mid-2014, represented by the yellow and green lines in this chart. While this likely reflects the increasing demand among first-time homebuyers we outlined earlier, it could also reflect tighter supply for lower-priced homes. For example, there are more than 2 times as many listings on Zillow for homes in the top third by value as in the bottom third. So far, we have described a somewhat complicated picture. An improving economic backdrop that should be positive for housing demand, a relatively tight level of supply, but activity that had slowed in 2018 and was accompanied by slower price growth with significant differences at a local level and trends that reflect shifting demand. So what happened in late 2017 and early 2018? A variety of factors likely contributed to the slowdown. First, rising mortgage rates are probably the most important factor. Housing demand is sensitive to rates, and some models suggest that higher rates could explain as much as half to 2/3 of the recent slowdown in housing. Second, a number of home builders also have pointed to rising materials, labor, and land costs as a factor in pulling back on activity in 2018. While materials costs have since moderated, home builder balance sheets continue to suggest that they have become less bullish about the price of finished homes relative to that of land. Third, while consumer confidence remains high, it weakened in the second half of 2018, particularly around the time of the equity market sell-off in the fourth quarter. Finally, changes to the tax code in late 2017 may also have contributed to weaker prices and lower demand for higher-priced homes in states with relatively high taxes. Starting in 2018, the mortgage interest deduction cap was lowered to $750,000, and deductions for state, local, and property taxes were capped at $10,000. This slide shows the effective rate on a 30-year fixed-rate mortgage. As we can see, federal funds rate hikes began feeding through to the mortgage market in late 2016, leading mortgage rates to rise by more than 1.5 percentage points, including roughly 1 percentage point in 2018. While rising rates predate the slowdown in housing, a lag is to be expected, and it is likely that as rates began to rise, some home buyers rushed to get ahead of additional rate increases. Furthermore, while mortgage rates remain low by historical standards, the sequential effect of a 1 percentage point increase is meaningful, raising a potential monthly mortgage payment by 13%. Encouragingly for future housing activity, effective mortgage rates have fallen by nearly 50 basis points since November, as the Fed has pledged to take a more patient approach to future rate hikes. However, it also is important to acknowledge that a number of longer-term factors continue to weigh on the recovery. Chief among them is affordability. While some measures of overall housing affordability suggest that housing remains more affordable than in the past, median home prices have risen more rapidly than median income in recent years, and a variety of more detailed studies suggest that affordability is a significant concern in more desirable housing markets. One factor contributing to affordability challenges in denser housing markets are zoning and other restrictions on construction. Beyond constraining supply and pushing up prices, these create incentives for construction targeting higher-priced housing, rather than housing more suitable for those taking the first step on the housing ladder. Both factors are more acute in several housing markets with greater employment opportunities, further contributing to potential supply-demand mismatches. Finally, a number of other structural factors likely contribute to the reduced housing demand versus prior cycles. Over the past few decades, Americans have increasingly moved less frequently and experienced important life events like marriage at older ages. For many Americans, particularly those entering the labor force at the time, the financial crisis significantly altered lifetime earnings, savings, credit scores, and feelings of security when it comes to housing. Aggregate student debt has risen by over 12% per year since 2003, and studies suggest that carrying student debt impairs home ownership. And finally, while credit standards have loosened mildly during the recovery, they remain far tighter than before the crisis. For example, the 10th percentile of credit scores at mortgage origination was 649 at the end of 2018, versus 576 in early 2007. While this chart is not a pure apples-to-apples comparison, it illustrates the longer-term affordability challenge. The blue line, real median household income, is more or less in line with where it stood at the turn of the century. Meanwhile, the yellow line, the real median existing home price, is nearly 25% higher than its 2000 level. So what does this all mean looking ahead? We draw 2 primary conclusions. The first is that while the housing sector has weakened, the factors driving underlying demand remain solid. This table summarizes the approximate annual change in the housing stock over the past few years. Assuming a household formation rate of 1.2 million households and projecting forward current rates of vacancies, removals, and mobile housing construction implies demand for roughly 1.4 million more units of housing per year. While it is likely that weakness will persist in the short term, this underlying demand ought to put a floor under that weakness. Over the medium term, it should provide continued upside, although at the modest pace of the recovery to date, given concerns about affordability and supply-demand mismatches. The second point is that the outlook for house prices and housing activity is likely to be driven by local dynamics, reflecting a more normal housing market than in the last cycle. On this slide, we isolate one particularly influential factor, the strength of the local labor market. Looking at the clustering of the dots on the left-hand chart, which represent 350 metro areas, we can see that they generally fall in a diagonal sloping down and to the right. This indicates that metro areas with lower unemployment rates have seen prices recover the most versus their pre-crisis peak. As we can see on the right-hand chart, during the pre-crisis housing boom, the relationship between housing price appreciation and labor market strength is less obvious, reflecting a housing market in which price growth was self-perpetuating, housing as an investment asset relatively insensitive to fundamentals. To sum up, U.S. housing activity and pricing slowed in 2018 due to a number of headwinds, including higher interest rates, longer-term affordability challenges, and declining confidence in the face of slowing economic growth. However, interest rates have since stabilized, household income is rising, and economic growth is still at solid levels. These tailwinds should underpin upside for the housing market in the medium term, even if weakness persists in the short term. As a result, we believe that housing activity will find a floor and begin to grind higher, and that price increases will continue, but more in line with the pace of wage and household income growth. However, many local housing markets may diverge significantly from national aggregates based on economic conditions.